While Donald Trump celebrates stock market records and declares American economic dominance, China is doing something far more dangerous. They're not threatening, they're not warning, they're simply building a financial system where the US dollar becomes irrelevant. And it's already working. The room was tense when Scott Bessent sat before Congress. As Treasury Secretary, he's supposed to reassure lawmakers that America's financial grip on the world remains unshakable. But during that hearing, something unexpected happened. Bessent didn't deny what everyone in that room already feared. He acknowledged it. Capital is moving. Not because of war, not because of sanctions, but because there are now other doors to walk through. For the first time in generations, money doesn't need America's permission to travel the globe. It can settle trades, store value, and cross borders through channels that Washington doesn't control, can't monitor, and, most importantly, can't shut down. This isn't a distant threat. It's happening right now. And the strangest part? While this financial earthquake quietly rumbles beneath the surface, President Trump stood in front of cameras pointing to the Dow Jones like it's proof that America is untouchable. He's talked about markets potentially doubling during his presidency. He's framed rising stock prices as a national victory, a symbol that the world still believes in the American system. But here's the uncomfortable truth. Those rising markets might not be evidence of strength. They might be evidence of desperation. Because while one side of the government is obsessed with keeping investors happy and confident, the other side is watching China methodically construct escape routes. And once those routes are finished, the dollar won't collapse overnight. It will simply stop being necessary. That's far more dangerous. Let's talk about what Trump is actually celebrating. The Dow hitting record highs sounds impressive. It makes for great headlines and even better campaign talking points, but strip away the theatrics and the math tells a different story. If markets were to double in roughly 3 years, you'd need annual returns approaching 30%. Historically, that kind of growth doesn't come from innovation or productivity. It comes from something else entirely: monetary inflation. Asset prices soar, not because companies are producing more value, but because the currency itself is losing purchasing power. And that's the trap America has walked into. Rising equity markets have become the primary indicator of national health. As long as stocks go up, everything else can be ignored. Deficits? Manageable. Debt interest payments? Not a concern. Foreign holdings declining? Just noise. The stock market has become the patient's pulse, and Washington will do anything to keep that pulse steady, even if the underlying body is deteriorating. Bessent himself has said that too many Americans don't own stocks, and he's pushed for policies that would bring more people into the market. On the surface, that sounds inclusive and democratic. But think about what it really means. It means the government can't afford to let markets fall. Ever. Federal Reserve data makes this clear. Stock ownership in America is heavily concentrated among the wealthiest households. These same households drive a massive portion of consumer spending. When their portfolios rise, they spend freely. When portfolios drop, they pull back sharply. The entire economy has become dependent on keeping the wealth effect alive. So, fiscal policy, retirement incentives, even deficit spending, it all subtly feeds into one goal: keep the markets elevated. If American dominance were truly secure, this constant reassurance wouldn't be necessary. The fact that it's needed at all suggests something fragile underneath. For decades, global capital had one clear destination: back into U.S. assets. Foreign governments earned dollars through trade, then reinvested those dollars into Treasury bonds and American stocks. This cycle kept interest rates low, markets stable, and Washington in control. China was a key player in that cycle. It ran massive trade surpluses with the U.S., accumulated trillions of dollars, and recycled those dollars right back into America's financial system. But that cycle is breaking. Trade wars became permanent strategies. Tariffs stayed in place. Technology restrictions expanded. And as America's fiscal deficits widened year after year, the appeal of holding dollars started to dim. Foreign investors still hold enormous amounts of U.S. assets, but the growth of those holdings has slowed. And that creates two immediate vulnerabilities. First, if foreign holders begin selling Treasury bonds in large volumes, interest rates spike. That makes borrowing more expensive for everyone: government, businesses, consumers. The entire economy feels it. Second, if foreign investors start exiting American stocks, the wealth effect collapses. Portfolios shrink, spending contracts, confidence evaporates. Either scenario shatters the narrative of endless American growth. And while Washington tries to manage this balancing act, China has been preparing quietly and methodically. During that same congressional hearing, Senator Cynthia Lummis pressed Bessent on what China is doing with blockchain technology and digital currency infrastructure. His answer was careful, but revealing. He acknowledged that China is experimenting at scale, particularly through initiatives centered in Hong Kong. He didn't dismiss it. He didn't downplay it. He admitted it's real, and that's the critical shift. China isn't confronting the dollar system directly. It's not launching public campaigns or making threats. It's building alternatives. And it's making those alternatives work so well that using the dollar becomes optional instead of mandatory. Right now, a growing share of China's cross-border trade is settled in renminbi, not dollars. For China's trading partners, this makes practical sense. If you're importing goods from China, why convert your currency to dollars, then convert again to pay the Chinese supplier? Why not just pay directly in renminbi? It reduces exchange rate risk. It simplifies transactions. And crucially, it increases demand for Chinese financial instruments, particularly bonds. As more trade flows through renminbi, those trading partners need stable places to hold that currency. Chinese bonds become the natural choice. Stability improves, liquidity deepens. And suddenly, the renminbi starts looking less like a speculative bet and more like a functional reserve currency. This is where China's digital currency program enters the picture. China's central bank digital currency, the digital Yuan, has scaled faster than any comparable project in the world. Transaction volumes have multiplied rapidly. The infrastructure is being refined constantly, making cross-border payments faster, cheaper, and more direct. Here's why that matters. Traditional international payments rely on correspondent banks and centralized clearing systems, most of which are dominated by Western institutions. Those systems give Washington leverage. They allow sanctions to be enforced. They enable financial surveillance. But a digital currency that settles directly between institutions bypasses all of that. No intermediaries, no centralized choke points, no leverage for outside powers. And China is scaling this infrastructure through something called M-Bridge, a cross-border settlement platform that operates independently of the dollar-centered system. Early transaction volumes were modest, but the long-term goal is unmistakable. Create a parallel financial network that works just as well as the existing one, without requiring permission from Washington. The competition isn't about rhetoric anymore. It's about which system global capital finds more practical, more stable, and ultimately more indispensable. Here's where the numbers become impossible to ignore. Once Chinese institutions took operational control of these systems, momentum accelerated dramatically. In just a few years, transaction volumes surged past 4,000, with total settlements reaching approximately $55 billion. Policymakers are now circulating internal estimates suggesting that figure could exceed $100 billion before this year ends. This isn't theoretical anymore. This is live infrastructure processing real money. And it's not just payments, it's reserves. Senator Lummis raised an even more sensitive question during that hearing: gold. Specifically, whether China might eventually back portions of its digital currency with tangible assets like gold. Bessent didn't confirm it, but he didn't deny it either. He said it warrants attention. That response alone is telling. Because while Congress debates blockchain experiments, data from the IMF and the World Gold Council reveals a broader pattern. Central banks across Asia, the Middle East, and even parts of Europe are quietly diversifying their reserves. They're reducing exclusive reliance on the dollar. Not dramatically, not publicly, but consistently. This isn't about geopolitical loyalty to Beijing. It's about risk management. Every tariff, every sanction precedent, every unpredictable policy shift out of Washington reinforces the same calculation. Having alternatives is safer than relying on one system. And Hong Kong has become the testing ground. By running these experiments through Hong Kong, China maintains plausible deniability. It's not Beijing forcing change, it's a global financial hub innovating naturally. International banks can experiment with digital renminbi settlements without formally breaking from Western systems. Political exposure stays low. Usage becomes routine. And once something becomes routine, expansion follows naturally. Even America's closest allies are watching carefully. European regulators now discuss ensuring their systems can interact with non-dollar settlement networks. They frame it as technical modernization, not political defiance. But the effect is the same. Diversification stops being controversial. It becomes common sense. Meanwhile, China is strengthening its financial foundation in ways that are almost invisible. The People's Bank of China has been steadily expanding state gold reserves. At the same time, domestic investors are accumulating gold through ETFs and exchanges. This dual approach serves two purposes. It reinforces internal confidence and it projects fiscal discipline to the outside world. Gold carries symbolic power. It represents tangible value when trust in paper currency weakens. And according to World Gold Council data, China has added to its reserves consistently for over a year, even when gold prices hit near record levels. That's not speculation. That's deliberate balance sheet management. Now imagine a digital currency even partially linked to gold. It wouldn't need to be fully convertible to shift psychology. Even limited backing would enhance confidence among central banks and institutional investors who recognize the vulnerabilities of purely fiat systems. Inside China, retail behavior is shifting too. Millions of new brokerage accounts have been opened recently. Chinese investors, previously cautious about their domestic stock markets, are re-entering in significant numbers. Capital is positioning. Confidence is returning. And all of this is happening while the dollar faces pressures created by American policy itself. Currency weakness reduces reserve demand. Tariffs shrink trade volumes, which means fewer transactions settled in dollars. Sanctions demonstrate how quickly financial dependence can become a weapon turned against you. Countries have learned this lesson the hard way. History shows how dollar shortages can destabilize entire economies, triggering banking crises, currency collapses, and runaway inflation. Observers worldwide have studied these outcomes carefully. India, for example, has navigated the complexities of trade decisions under U.S. scrutiny. Other nations have watched partners get cut off from dollar access suddenly and completely. Against that backdrop, China's alternative settlement systems offer something invaluable: optionality, the ability to trade, store value, and move capital without exposure to external pressure. This isn't necessarily confrontation, it's strategic insulation. So what happens next? Beijing could accelerate exports of high-technology goods. It could deepen domestic capital markets further. It could experiment with commodity-linked digital currency structures. Or it could pursue all of these simultaneously. The crucial point is this: the institutional groundwork is already in place. The US dollar still benefits from decades of network effects. It's entrenched in global finance. But network strength weakens when participation starts feeling conditional. When countries worry that access could be revoked. When alternatives become functional. Markets can overlook that reality for a while, especially when liquidity is abundant and stocks keep rising. But confidence changes when it has to be constantly defended rather than naturally assumed. The real risk isn't that dollar dominance disappears overnight. It's that the dollar's inevitability erodes gradually. For decades, the dollar's power rested on being the default, the only real option. But when viable alternatives exist, inevitability fades. And this transformation is happening largely out of sight. No grand announcements, no fixed deadlines, just incremental shifts in how transactions get routed and how reserves get allocated. Once those patterns solidify, they persist. They don't require formal endorsement or public declarations. They simply become the new normal. So here we are. Trump points to stock market records as proof of American strength. Bessent sits before Congress and quietly admits that capital is finding other pathways. And China continues building, testing, and scaling systems that don't need Washington's approval. The competition for global financial dominance isn't being fought with missiles or sanctions anymore. It's being fought with infrastructure, efficiency, and trust. And trust, once lost, is almost impossible to rebuild. The dollar isn't dying, but it's no longer inevitable. And in the world of global finance, that might be the most dangerous shift of all. If this analysis opened your eyes to what's really happening behind the headlines, hit that like button and subscribe. The financial world is changing faster than most people realize, and we're here to break it down without the noise. Drop a comment below. Do you think the dollar will remain dominant, or are we witnessing the beginning of a new financial order? Share this video with anyone who needs to understand what's coming. And remember, knowledge is power, but only if you act on it. See you in the next one.